So the big question is this: how do investors like us who trade options and manage our own money generate income regardless of where the stock market goes, and do it all in a way that lets us make time for the people and things we love, and yet still build wealth and remain profitable? That's the question, and this podcast will give you the answer. I'm your host, Kirk Duplessis, and you're listening to The Daily Call from Option Alpha. Hey everyone, this is Kirk here again from Option Alpha, and welcome back to The Daily Call. Today we're going to answer the question, can you close a covered call before expiration? So this question again comes out of our Facebook community. Somebody sent me a message and they said, Kirk, can you manage a covered call if the stock rallies up to your short strike before expiration? So assuming you want to keep the stock, of course, maybe you roll your call to the next month. So again, I think the key part here is that they want to assume that they, for some reason, want to keep the stock and do not want the stock to be called away. So if you have a covered call position on and the stock rallies past your short call strike, at the end of expiration, if you don't do anything, basically what will happen is you'll get a sign on your short call option. But since you have the underlying shares of stock in your account, which creates the covered position, basically it's a wash. You just close out of the position at whatever the net price is for the covered call. So if you don't want to have that happen and if you want to maintain it, then yes, you can close out of and reverse your short call option position and roll it to the next month. Now, just be careful when you roll these positions to the next month that you don't just roll to another in-the-money strike in the next month, because if you roll to another in-the-money strike in the next contract month, you still could be at risk of assignment. Say if there's a dividend coming up or something's happening in the stock or earnings are going to be announced, you still could be at a little bit of a risk of assignment, even though you've rolled the contract out to the next expiration period. Now, likewise, you can also close your covered call if the stock moves away from you. So the stock starts to fall away, and you want to actually close your short call option and roll down to a closer strike price to take in some more premium. You can do that as well. Remember, all of these option contracts, unless they're on a European style index like SPX, NDX, RUT, etc., you can close out these positions and move the contracts anytime, and you don't ever have to deal with any of the risks of assignment if you remove the option position. So hopefully this helps out. As always, if you have any questions, let me know. And until next time, happy trading. Thanks for joining us on The Daily Call. Be sure to subscribe right now for more daily options trading ideas, strategies, and tactics to help you learn how to place smarter, more profitable trades. And if you like what we're doing, don't forget to give us a rating and a review so we can continue to bring you the best daily content possible. We'll see you again tomorrow, right here on The Daily Call from OptionAlpha.com.